Okay, so our first speaker is Josh Knight from Octane Capital. And as before, well, actually, first slide, you should have received in the post Octane's lending guide, which covers mostly bridging, which is what Josh is going to be talking about today. I had taken liberty to also send all of you by email this morning their buy-to-let product guide, because their buy-to-let products are unique in the marketplace. But Josh isn't talking about that today. He's talking about the bridging side of things. So you would have had one of these in the post. It's taken up loads of our ink on our printer, as you can imagine, but it's well worth it, believe me. So a little bit about Josh, first of all. Sorry, no, I've also sent you this, by the way, and it's not the COVID-19 edition. You'll be pleased to hear, Josh. It's actually the new one, but I didn't have that on the slide. Okay, so Josh joined Octane February 2018 from Mariana Capital, where he was head of sales, and Josh has 10 years experience in managing intermediary relationships across private equity and property finance during his time at GMAC RFC, Octopus Investments, Mariana Capital, and now Octane. Josh has a real passion for property finance, having been exposed to startup packager and lender businesses from a young age. He enjoys the challenges the specialist property finance market presents and likes to work on difficult scenarios. His interesting fact is that in May, Josh completed 5 marathons in 7 days and raised over $4.5 grand for NHS charities together to support NHS workers and volunteers on the front line of the coronavirus pandemic. So a virtual round of applause for Josh, please. I think I could probably do with 5 marathons in 7 days just to lose my COVID weight. But anyway, so Josh, it's different to the last one you did, because I've actually included all your introduction on the front of your slide. So you now take over. So over to you, Josh, and I'll see you in about 20 minutes.
Good stuff. Thanks, Tony, and thanks for having us on today, guys. As Tony mentions, my name's Josh. I'm the BDM at Octane Capital that looks after the relationship with Tony and his team. Today we're going to be talking just about bridging, but we do much more than that. So I'll give you an indication at the end of the presentation as to the other areas that we're involved in. Very briefly, an introduction to Octane as a business. So we are a private specialist lending company. We're just over 3 years old, and we were founded in early 2017 by the 3 guys that are the original founders of what is now one of the largest specialist lenders in the country. So together, before launching Octane, they had lent just over £3 billion. Here at Octane, in the 3 years that we've been lending, we have lent just under £1 billion. So we're growing and lending quite aggressively, despite being a newer lender in the market. This year and last year, we won Bridging Lender of the Year at the B&C Awards. And this year and last year, we also won Bridging Lender of the Year at the Moneyfacts Awards. So it's the double for 2 years running, which is something we're really proud of. Octane are a joint venture with our funding line, a hedge fund called Pamplona Capital Management. So they're an equity partner in the business, and they also provide us with the funds with which we lend. So it's a fairly uncomplicated funding arrangement, which gives people comfort that when we say that we're going to fund a deal, we know exactly where those funds are coming from. So these are the 4 areas we lend in, and I'm going to talk a bit about bridging, developer exits and refurbs, because they all typically come under the bridging banner. I'm not going to talk about buy-to-let, but we do have a buy-to-let solution that Tony and his team know a lot about. So if you do want to hear more about the complex buy-to-let cases we can help with, please do get in touch with one of the team. We'll start with bridging. So for the time being, we are focusing on residential property. In previous years, we had some appetite for commercial property and land with planning, but for this year, which has been a difficult year, our focus is on residential property. Just on that point, by the way, and just to come back to something that Tony said, we actually did see quite a few lenders run for the hills this year, and quite a lot of our competitors stopped lending or restricted their criteria so much that they might as well have stopped lending. Octane have continued to lend throughout this year across our entire product range. So we've been here throughout, so that's an important point to note. Our minimum loan size is 150,000. We lend mainly in mainland England, but we have some appetite for Wales as well. Really flexible on how the loan is structured. So things like Octane's fees, how much the introducer's paid, the term of the loan, how interest is repaid. We're really flexible on those types of things. There's no set structure that the loan has to meet. Our maximum loan to value for the time being is 70%, although we can get to 85% of purchase price in the event the purchase price is less than the market value. So if it's below market value. I've put 4 examples there of the types of scenarios that we can help with, or most commonly help with. Rapid acquisitions, so auction purchases, pre-planning bridges, which is something I'm going to talk to you about in the next slide, complicated borrowers. Just on that point, Octane are very flexible when it comes to borrower profile. So foreign nationals, expats, adverse credit, borrowers with low income, borrowers with limited experience, the types of things that might deter other lenders won't necessarily deter Octane. And also larger loans. Unlike a lot of lenders, we don't have an upper limit on loan size. We like really large, chunky transactions. And to try and attract those types of deals, we have a large loan rate discount. Our rates significantly reduce when the loan size goes above £1.5 million. So I'm just going to talk you through one of the most common scenarios that I personally see, and it's what we call pre-planning bridges. It's the idea that somebody's buying a property with the view to attaining planning permission, but because they haven't acquired the property yet, they don't yet have the planning needed. So the way that we approach this is in 2 stages, and this is a good example. Here we had a borrower who was buying this property you see in the bottom left-hand corner. It's a vacant semi-commercial unit, so it's got a retail unit with 2 flats above in Bristol, and it's being purchased for £500,000. Once the borrower has acquired the property, he wants to convert it into 4 flats, making the property wholly residential. But clearly he hasn't bought it yet, so the planning permission is not in place. So stage 1 of the process would be a pre-planning bridge. Here we lent 65% loan to value on a 12-month term with 2% in, no exit fees, and a rate of 0.7 a month. What's nice about this type of transaction is that as soon as planning permission is in place, we're then there ready to help with the funding of the works required with the project. So once planning permission is attained, we move the borrower from a bridging loan to a refurbishment loan. Now, we only charge fees on additional funds borrowed, so the borrower is not getting double charged here. However, the broker does get 2 procuration fees, so it's nice for you, but the borrower is not disadvantaged in any way. The day 1 loan of our refurbishment facility is enough to refinance the bridge, and in addition to that, we fund 100% of the cost of the works in arrears. Similarly, it had a 12-month term and the rate was similar, 0.73 a month, but it gave them the ability to complete the project in this way. So we fully funded the cost of converting the property into 4 flats, and as you can see, the property is nearly complete. This is an actual picture of the project in its current stage. So pre-planning bridges, whether it's a house that they want to convert into an HMO, a commercial property that they want to convert into flats, whatever the case might be, a bridge to help them buy it and a refurb when they get planning can often be a good solution for them. Next, I'm going to talk about refurbs, which is similar to the second stage of the last slide. For me personally, I think that refurb loans are what Octane do best out of everything that we do. And I'll come on to why I think that in just a sec. The same headlines are true. 150,000 minimum loan size. We lend throughout mainland England and Wales, and typically it's residential property and residential projects that we're interested in. The way that we approach these deals is that for the time being, we're at 70% max against the day 1 value of the property, and we fund 100% of the cost of the works. Just on that point, very soon we will be back to 75%. Early next year, I suspect we'll be back to that point. So 70% day 1 plus 100% of the works. Now, there's 2 things that make us a bit different to other lenders. The first is that we don't retain any interest from the day 1 loan. Interest is rolled. And that means that when we say 70% day one, it essentially means very close to 70% net day one towards the purchase. The only thing to come off your 70% would be an arrangement fee. So 68% net. In addition to the 68% net, we fund 100% of the cost of the works, which the borrower draws down on throughout the project. We never insist on a QS. We never insist on revaluing the property at each stage. An Octane asset manager oversees the build, and every time a drawdown is needed, he oversees that process. So the types of deals that we do a lot of are properties being purchased at auction that are in bad condition. So light refurbs, decorative refurbs, new kitchen, new bathroom. We also do a lot of loft conversions and extensions. But for me personally, what I see a huge amount of, especially this year, is house to HMO conversions. Borrowers that want to improve the yield of their portfolio, they want to buy a 3-bed house and they want to convert it into a 6-bed HMO. We also do house to flat conversions, and every now and again, commercial to residential. Let me talk you through an example. This is again a real loan that I personally completed this year. Not particularly glamorous, but I wanted to give you a realistic idea of the types of deals we're completing day to day. So the property there in the bottom right-hand corner is a 6-bedroom house in Liverpool. Full planning permission was in place for the conversion of the property into 3 flats. Now, obviously, if planning permission wasn't in place, we could have done a pre-planning bridge as per the last case study. But here, planning permission was in place, so we could go straight into a refurb. The borrower wanted to buy it for £350,000, wanted to spend £138,000 converting the property, and once complete, the property would be worth £635,000. So day one, we're at 70% against the day one value of the property. So gross, 245,000. What you'll notice is that the net loan is very close to the gross loan, because just to reiterate, we don't retain interest from the day one lend. And that is different to how most lenders do it. You'll find that a lot of lenders do retain interest, and consequently, their day one advance is much lower because 12 months of retained interest has been deducted. That doesn't happen with us. So 70% day one is very close to 70% towards the purchase. In addition to that, we also fund 100% of the cost of the works. 138,000 would be drawn down on throughout the term of the loan. 12-month term, 2% in, and our rates are typically range from around 0.73 to 0.78 a month. And that's one point that I actually forgot to mention. Our rates are driven by loan to GDV, not loan to day one value. And that means that our rates are often a lot cheaper than a lot of the options available in the market. We often see 0.8s, 0.9s, or even sometimes north of 1% being offered. And our rates are keener than that. Just going to answer a couple of questions from Max. I've seen them pop up. Is your interest rolled up? Yes, interest is rolled up. So if we start at 70% and we roll interest, we're rolling up to a maximum of 65% loan to GDV. So day one loan plus interest plus cost of works cannot exceed 65% of GDV. That's our maximum. The other question was, does the borrower or do the lender pay an arrangement fee on the refurbishment mortgage? So this is a question relating to the pre-planning bridge. The answer to that is yes, there is an arrangement fee charged on the refurb, but it is only charged on additional funds borrowed. I'll come back to the rest of the questions in just a minute, but I'll answer them as I go. So yeah, just on that refurbs, the two things to have in your mind: 70% net day one, 100% of the works funded, house to HMO conversions, house to flat conversions, commercial to resi, or even just decorative refurbs for properties in bad condition. For me, I think that is what Octane do best. And finally, developer exits. Now, people talk about developer exits often like it's a different type of product, but a developer exit is just a bridging loan used for a different purpose. The idea behind a developer exit is that if somebody has built a property, or if they've built lots of properties, and they've used development finance to fund the build, we often find that they get towards the end of their existing facility and they haven't yet sold or even sometimes finished the properties, the development, in order to repay their existing loan. So a developer exit loan steps in, takes out the development finance and gives the developer more time to sell or even sometimes to finish and sell the units. We lend, again, mainland England and Wales, again, minimum loan 150,000. And the rates, much like bridging, they start at around 0.5 a month and they go up to about 0.8. That's really our scale for everything you've heard today. 0.5 is the lowest rate you'll see from us, and 0.8 a month is the highest rate you'll see from us. It never really goes lower or higher than that. And that puts us, if I'm honest, probably towards the lowest end of the market in terms of rate. You will find cheaper, but we're really competitively priced. What you find with developer exits is they're often quite big, they're bigger loans, because often it's multiple properties that are involved. And that means that our large loan rate discount often comes into force. The three types of scenarios we most commonly see: simple sales exits, which means somebody's built some properties, they just need more time to sell them. No more complicated than that. Sometimes there's also a capital raise involved. The borrower wants to raise funds against the development in order to fund onward projects. And then finally, bridge to let, which I won't talk about, but we do have a solution for where a borrower has built some properties, they want to sell some and let some. So they need a sort of hybrid between a bridge and a buy to let that gives flexibility on both sides. And we do that. Tony and his team are really familiar with that. So I'm just going to talk to you about this. This is the biggest loan I completed this year. It was a long time ago now. I'm still dining out on it, so I still like talking about it. And big loans like this don't come along for me too often, but it's really nice when they do. So this was our developer had built 52 units in Ickenham, which is near Hillingdon, sort of west of London. Classic developer exit scenario. He had sold 17 of the units, so he had 35 units left to sell, and he was getting towards the end of his existing facility with his development lender who had funded the build. Now, his development lender were doing what lots of lenders do and applying some real pressure to be repaid. They were a month or so away from the term of their loan, and they wanted their money back. So there was 14.5 million of security left, the 35 units, that's how much they were worth. And he only had 8 million outstanding. So he was fairly lowly geared. He also, as well as getting his development lender off his back, he also wanted to capital raise on the value of the properties to fund another project that he had on the go. We often find that with these serial developers, they have 5 or 6 different projects on the go at one time, so cash flow can often be an issue. So here we lent at 70% loan to value. So we lent just over £10 million, which was clearly enough to clear the current charge, the 8 million outstanding with his development lender, but also to give him a fairly sizable day one cash release for him to go and fund other projects. Actually, interestingly, we also agreed with him that every time he sold one of his 35 remaining units, we'd split the sales proceeds. So rather than having to use all of the sales proceeds from each sale to pay down our loan, he got to keep a proportion of each of the sales, which he really liked. Now you'll notice here, this is unusual, and it comes back to my original point at the start, which is that we don't care how loans are structured. It doesn't have to have a 2% arrangement fee. If we need to be creative, we can be. And for a large loan like this, where you're asking a borrower to move from one lender to another, it wouldn't be very palatable to charge them another 2% arrangement fee. So we dropped our arrangement fee to 1%, and we paid all of that to our introducing broker. And what you'll notice here, despite the fact that we are at max leverage, our rate was almost at our bottom, our lowest rate. 0.58 a month was the rate that we charged here. And again, when a loan goes above 1.5 million, our rates significantly reduce, regardless of whether you're at max leverage or not. So for these bigger deals, we want them, we've got the funds to fund them and the experience to fund them, but also we can be really keen on rate. I'm just going to answer a couple of questions because I see a few built up. From Atul, can you arrange 100% bridge with additional security? Yes, but the additional security has to be suitable security, and unfortunately we're not lending on land at the moment. So if it was a resi property, absolutely, 100% of purchase price with additional security, no problem. Several bridge loans during lockdown were unable to exit for obvious reasons and would like an extension. Would we allow an extension? Yes. Now, unlike some lenders, we don't charge extortionate fees on the day you go over term. It's just not the way that Octane operate. We would let you, the broker, and the borrower know well in advance of the end of the term that the loan was coming to term. We typically charge a 1% extension fee. Some of that can be paid to the introducer if needs be, but we're not in the business of overcharging clients. And I know there's lots of lenders out there that do that. Finally, Matt, what is your release pricing then on net sales proceeds? It sounds like less than 100%. Yeah, so the way that we did it with this loan, Matt, is that we agreed, actually a bit complicated, we agreed that on the first few sales, he could keep 20% of each sale and we would keep 80. But then we agreed that when we got sub 50% loan to value, the proportion of each sale that he could keep increased to 40%. So 20% down to 50% loan to value, 40% thereafter. But that's just what we agreed on this case. You know, that's a case by case sort of scenario. Just before we go on to questions, we got a really straightforward process. We've moved it all online. So the broker fills out a 2-page application form, no borrower signature needed, no ID needed, no sending back and forward forms and all that stuff. Once the broker's filled out an application form, the borrower goes on to our online process here, completes a few questions, and then we start underwriting. Just one point on service, just before I just go to questions. There's a few things that you can expect from Octane. The first is, if you send us an inquiry, we'll get you an AIP in 2 hours. If you send us an application, you'll have a full credit update with valuations instructed in at least 1 day. Normally the val and legals can be instructed straight away, and the underwriting update will be with you in 24 hours. Octane's entire team, the entire 28 people that work at Octane, all have been working full time. Nobody's been put on furlough, and we haven't seen at all service levels drop. And we're happy to be held to account to that, but we can say with confidence that if you ask us a question, whether it's me or a credit manager, we'll get an answer quickly. And we say that with real confidence that that's the experience that you'll receive from us. I think we've got time for a few questions. If anyone has any, happy to field them.
Okay, Josh, I'll come back on, just as the slide says there, any documentation needs you've got, our website now contains the documentation of every lender, which is probably one of the most difficult things we've ever done, because trying to keep them updated is incredibly hard. But certainly Octane's is bang up to date at the moment. So just go to lenders.specialisthub.co.uk/Octane, where it's got basically everything you need. And if you want to discuss a case, there's a free phone number there. Plus, but all of that information is on the product guides that we sent to you, just so you're aware. There you go. Atul was asked, max lending, regulated bridge is the second charge, which I'll answer if you like, Josh, because Atul, they don't offer regulated bridging at this moment in time. Unless you can tell me.
Right. No, you're absolutely right. I probably should have mentioned that, so I'm sorry, Atul. The main things Octane don't do anything regulated. We don't do second charges, and we don't do ground up development finance. We also don't do commercial term loans. They're the 4 main things we don't do.
Okay, and as Peter said, sounds like you are very flexible, which they certainly are. I'm just going to comment on one thing. Obviously, Josh has already said that they stayed with the market throughout. They haven't put anybody on furloughs. They've just basically operated as normal. Those of you that follow me or that have are a contact with me on LinkedIn might have seen a post up a couple of months ago, where it's very rare I actually put something up or advise a lender if put something up public. But I did actually say, I mean, their offer to completion process is probably the best I've seen in many years. It was absolutely, they had one member of staff who was literally aggravating the life out of both sets of solicitors and just ensuring that they were doing their job. And when things were sort of slightly slowing down, he was inactively trying to ensure, is that something we can do post-completion? It was a delight to see. The other thing I'll say is that one of our delegates back in, I think it was either July or August, put a couple of cases over to us, and both went to Octane. And that guy had never used this before, and I can't remember exactly the day. I think it was sometime in August. During August, we paid him over 24 grand in commission from those two Octane completions. So he's a very happy man. He's so happy that yesterday, Josh, you'll be delighted to hear, he gave us a £9.8 million case, which I will be speaking to you about 1 minute past 1 today. Documentation over just whilst you were speaking. So yeah, that's one that potentially could be. We haven't got Peter. That's when we all get paid. Thank you, Pete. Yeah, just one question, because we are just slightly over time. Age-wise, what's the max age you'll go to, Josh? And in what situations can you extend it?
So 70 is our maximum age. So for bridging, it's less of an issue, because if the exit of the bridge is the sale of the property, we don't really care too much about age. If it's a buy-to-let loan, 70 at the end of the term, so 65 at the start of the term, unless there's a joint applicant or there's a joint applicant who's younger, or another shareholder in the company who is also younger, in which case we can be flexible.
Okay. No more questions, Josh. Thank you very much indeed. Excellent presentation as always. Remember to give that man 5s when you get your feedback form later on. So Josh, like I say, 1 minute past 1, I'll be on the phone. All right.
Thank you so much, guys. I appreciate your time.
So Josh, thank you. Now on to our next speaker. Okay. The reason I'm doing a little bit of a delay on these, by the way, is that we are recording all of these, and these will then be available to you again via our website. So it's just so I'm not actually constantly talking, and my team are trying to edit it afterwards. Just one thing to say, if you are watching us on YouTube, which I can see there are a few people now watching me live on YouTube, if you could just put your name in the say something box, that way we know that you are on, and we can then send you your CPD and other bits and pieces can go out to you, although that should be happening automatically. So just do that. I see Kerry's just come on board. So Kerry, can you hear us?
I can. Can you hear me?
Yes, I can. You're a little bit faint and tinny, so you might need. Have you got a mic, or maybe move slightly closer to where your mic is? Might be on your computer.
Let's try this. Is this a bit better?
Yeah, a little bit better. A little bit. Right. Okay. So just introduction on Kerry now. Now, as you can see, UTB have done their slides in a different format. So I was struggling last night to get actually everything to fit on the pages. So our second speaker is Kerry Bradley from UTB. And there's a nice picture of Kerry with an owl in the background. Okay. You should have received in the well, most of you will receive by post, but some of you all received this via email this morning. The product guides for both first charges, regulated first and regulated seconds. So please refer to that. Okay, so a little bit on Kerry first of all. As an experienced BDM working at UTB for 2 years, Kerry's role is to work with specialist mortgage brokers. Her area is South, and she can help brokers by providing residential mortgages and second charge loans for a wide range of purposes, from purchasing property, remortgaging, or to capital raised from their property for a variety of different purposes. She really enjoys spending time with her 7-year-old son, who might be 8 now, by the way, because this was actually given to us back in July, I believe but he might still be 7. A 7-year-old son, socialising with family and friends, and a new puppy called Maybelle is keeping all the family busy. A really good night in will be watching a crime drama or one of the Real Housewives shows, a guilty pleasure. so much like my wife. Honestly, I just believe. Well, my wife would not be having a glass of prosecco; it'd probably just be the bottle. Don't tell my wife, anyone, if you see it, or a G&T, of course. Kerry's interesting fact is she's a keen Spurs fan, and as a teenager played for Haringey Girls five-a-side team. So Kerry, over to you, and I'm going to go and start shouting West Ham in the background. So it's all yours.
Fantastic. Right. Thank you very much, Tony. So hello, everybody. Thank you for taking the time to meet with, obviously spend some time looking about us. So obviously Tony's obviously given you a bit of a background of me, so I won't bore you too much about me again. Just give you a bit more background, obviously my experience. Now I've been with United Trust Bank now for 2 years, and prior to that I was with another specialist lender in the background. And in fact, I've probably been with specialist lending since 1999. So all my experience has been within specialist first and second charge mortgages, as well as bridging, development, commercial lending. So just to give you a little bit about United Trust Bank, if you're not aware of who we are, what we do. So the bank itself was founded back in 1955. And it was development finance and retail deposits that were the founding elements of our lending strategy. We evolved and came further into the lending market and launched a bridging finance product back in 2010. So we now have quite a large presence within the bridging market for regulated first and second and unregulated first and second charge bridging products. 2011, we launched asset finance as another division within the bank, offering clients hire purchase finance leasing arrangements and refinance of other assets such as cars, agricultural equipment, construction equipment, and so forth. 2015 was a significant year for the bank. We launched ourselves into the second charge market, and this is where the bank has really grown from strength to strength in regards to the product sets. 2019, only last year, feels like a lifetime ago based on this year, we launched into the first charge lending market. So now within specialist mortgages, we have first charge purchase, remortgage, unencumbered, interest only, and we have second charge products. So we have a lovely suite of products available. It's available. Our first charge and second charge product range are for multiple reasons. Any legal purpose is what we stand by with regards to purpose of loan borrowing. So the ifs, buts, whys, what's, reasons for clients borrowing money is quite vast for us. So don't be put off by asking a question if you think it may be slightly unusual or not quite conforming. Please let us know and we can see if we can help you. We've put on there 2020 and beyond because it's one of those questions that you say is, where do you see yourselves? What's happening? What's lending looking like from the bank's perspective? Well, very, very similar to what Josh has spoke about with Octane. We have continued to lend throughout this year. We didn't close our doors for one day with regards to lending. We kept the door open, we kept our book open, and we continued to lend to our clients. The ethos that we have at United Trust Bank is that we're not here without you as our introducers, our packaging partners, our mortgage brokers. We rely on you to work with us. So if we're not able to support you, then obviously you can't support us. So we're very, very passionate about making our relationship and partnerships work with everybody. And we're very proud to say that, again, we didn't furlough any staff. In fact, we had a recruitment drive throughout the summer, and within the summer period we actually launched what we called a broker support package, and this enabled us to launch enhancements to our existing product range. We increased our technology offering, and we were able to re-implement some positive changes within the existing product range to support you to sell the products or more products out there when there was a limited market. So just moving on quickly in regards to who we lend to. So I'm going to try and sort of keep it sort of high level, but obviously I can answer more questions later on for you with regards to sort of more criteria based. I don't want to sort of spend here talking about rates and products and LTVs as such. I think the key thing for me today is to explain how we work and how it works for your clients and the types of clients that we can help, because it's actually quite varied in regards to how we work. So I'm going to start off talking about the people and the types of employed income that we can accept. So employed applicants, we can accept standard employed applicants. Now they only need to be in their current role for a minimum of 3 months if they have a 12-month employment history behind them. As long as they're not in probation, they can apply to come to us directly as of 3 months only. If they don't have a 12-month employment history, then we can consider somebody that maybe has been in their current role for 6 months, not in probation. Again, that will be acceptable to us. We also will accept clients that are on 0 hours, bank workers, and second job income is also taken into account. We do cap the number of hours working per week to 50. So as long as it works for the customer that they can qualify within that, we can consider lending and using that income. We have reintroduced overtime and bonuses back into our lending criteria. So now anybody that is in receipt of overtime that has been doing it continuously for an 18-month period, we will use 50% of that as long as evidence is provided. Bonus income, we will accept monthly, bi-monthly and quarterly. Unfortunately, we don't accept annual bonuses, but obviously we do have the flexibility regarding the monthly or quarterly bonuses. And I've just covered off the minimum time in current job is 3 months with 12-month history, or only 6 months with no 12-month history. Just moving on now to self-employed, we will accept sole traders, limited company, directors and partnerships. If you are a sole trader, we will use your gross profits as your form of income. If you're a limited company director, we will use your dividends or salary drawn. We will require you to be self-employed, whether it be under limited company or sole trader, for 2 years with 2 years evidence of accounts or SA302 submissions. Excuse me. I'm pleased to say that we actually part of one of our broker support packages in the summer, we actually introduced lending to contractors. So this is quite new to our policy, or an addition to our policy. So all we ask for a contractor is that they are 1 year trading with accounts. We will apply a day rate over a period of 48 weeks. And we will accept limited company, UK-based umbrella companies or limited companies if their payment structure is through those type of entities. With additional income here, we have pension income, benefit income and lending into retirement. So what's not listed on here is additional income such as savings, investments, as well as buy-to-let income. So again, we will treat buy-to-let income as we would if it was a sole trader income. So as long as they've been doing or receipt of buy-to-let income for a period of 2 years, and there's 2 years evidence of SA302 submissions under UK land and property, we will accept that as income. So again, if you're not quite sure, please let us know. We're happy to help. Now, this is probably one of my most passionate and favourite areas about the bank. What do we lend against? So one of the key things for me is that we don't have an LTV restriction depending on property type. So, for example, if you've got a property that happens to be a flat, or it could be an ex-local authority flat, above a shop, and the shop happens to be a food outlet, restaurant, takeaway, and it has shared balcony access around the back, we will go up to typically either 80% for a second charge customer, fitting within our zero status products, or we will go up to 75% for self-employed on that particular product range. So there is quite a lot of flexibility in regards to the types of property. So I'll go into a bit more depth about that now. So the key thing for us, is it mortgageable, is it habitable, and is it traditional to the area? We will lend on non-standard construction types. Now that could well be precast, timber framed, flat roofs, flying freeholds, converted barns, old farmhouses. You know, we don't restrict the number of acres within a land. However, we don't want to lend on anything that has agricultural ties as such, or restrictions, or is working farmland. But we have done quite a lot of quirky asset lending. So, for example, we've just agreed to lend on a property that has one title, 2 properties on land, one's a cottage and one's a converted residential windmill. You don't see many of them very often, but we've actually just agreed to do something like that. So again, if you're not quite sure, or you're having trouble with maybe an existing lender that's declined a property type, then please pick up the phone, speak to us at UTB, speak to the team at SFS. Tony's team are very knowledgeable with our criteria. They'll be able to obviously see if it works for us. And as I said, the key thing for us is to ensure that the property is mortgageable. So, you know, there is an opportunity to speak to valuers, run the case by them if you wish to do so. And one of the other key areas that we lend a lot against, as I've mentioned, is flats above commercial. So again, there isn't a restriction on the types of asset with underneath the leasehold of what we're lending against. We don't have that, what the high street call the sight, sound and smell rule. However, well, typically I tend to say, as long as it's it's non-illegal activities within a property, tends to be something that we try and avoid. But obviously, anything that you're not sure about, please let us know. We do a lot of properties in high rise. We don't restrict the number of floors within a block. So, for example, you could have a 25-storey and we're lending on the 15th floor. We're seeing actually more and more of these purpose-built high-rise developments coming into fruition now, especially in the East End of London, and we're more than happy to lend against those assets. So again, just pick up the phone and see what we can lend against for you. So just moving on now to products. So I'm going to go a bit more depth here. So I didn't want to overwhelm with too much going on the presentation. So I'm going to start going around with our USPs. So one of the key things that we work on is that we don't work off a credit score. So we use Equifax as our scoring template, which obviously gives us quite a lot of information that we need from there. But again, no credit score is quite key. Lending into retirement. So again, another key USP for us is that we start lending both on first and second charges from the age of 18 to 85. The only downside at the moment, and this is only at the moment, is that we don't lend to first-time buyers on our first charge product range. That will be changing very shortly in the coming months, but currently we don't actually have a first-time buyer product available, but there will be one very shortly. On there it says obviously married and sole applicants. So great news here is that if you've got somebody or a married couple that happen, one of the partners isn't on the title deeds and the client wishes to do a second charge, then they can go ahead and do a second charge without that married partner being a party to the borrowing. So again, there's some flexibility about obviously how we can structure it. We have a wide variety of products, prime and near prime products. Now, how we assess a client is based on their profile. Now, again, as I've mentioned earlier, we don't work off a credit score. What we do is profile the customer based on their last 12-month credit profiling history. So we look at the credit profile and we assess on status points. So as an example of this, you could have a customer that has had 3 or 4 missed credit card payments as recently as of October just gone. If they've brought those accounts up to date and they're now showing a 0, or the creditor confirms they're now all up to date, we would treat that customer as a prime customer. And in theory, we would disregard those missed unsecured payments. So then that gives us great flexibility about the profiling of a customer. If you've got a scenario where a client has had a missed mortgage payment in the last, say, 12 months, but it wasn't actually missed, it was late, and they paid it within 30 days of the due date, we will in theory ignore that as a missed payment on their credit file and treat them again as prime customers. If there's multiple missed payments within that, obviously that's a different story. But if it was a late payment, we can disregard it as a missed payment and bring them from maybe a 1 status up to a 0 status plan. There's also flexibility around payment holidays, which is quite a key question at the moment. A lot of clients have are in payment holidays for unsecured and secured lending. Now, we've taken the view that we will accept clients that have been in a paid holiday. All they need to do is evidence that they had a pre-agreed payment holiday at the time and they are now out of that payment holiday and they are back to paying their normal monthly payments as per the holiday payment arrangement. So again, we've taken the decision again to help support our brokers and clients of having a lender that can support in these difficult times when it comes to the payment holidays, because as we all know, clients aren't made aware that if they do go into a payment holiday, certain institutions will actually log it as a missed payment on their credit file and not an arrangement as such, which has a huge negative impact on those customers for the next year or 2 years. Just going back to the profiling as well, Obviously, we have a very flexible approach to unsecured missed credit. Now, if you have a situation where a client needs to do a consolidation, but they haven't been able to bring up their existing credit back up to 0. So they could be showing, say, for example, they could have 5 accounts, including HP, personal loan, credit cards, that are showing as a status 4 across, say, all of them. If they're doing a consolidation with our loan purposes, we will allow them to go ahead on a 1 or 2 status product plan. We won't bring them up to 0, but we will allow them to go into a 1 status or 2 status plan. And the key thing for here is to ensure that there's no CCJs or defaults within the last 12 months. But again, there's some flexibility around that. So again, for example, if you've got somebody that has a CCJ or default that was either for a communication supplier or mail order, or it's for the value of £300 or less, we will actually ignore it for our plans. So again, there's some flexibility around clients that have had CCJs or defaults within the last 12 months. Moving on to our product range itself, we have a large variety of product offerings ranging from 2-year, 3-year, 5-year fixed rates with ERCs. We have tracker rates with no ERC tie-ins, and we also have a 5-year fixed with the without ERCs. So there's quite a lot of flexibility regarding the product range. We charge a flat fee structure with regards to our product arrangement fees. There is no fee payable to us as such until upon completion. If clients wish to pay any of their arrangement fees to us, we will contact the customer before we go to binding offer and take payment off them that way, or typically everything's added to the loan. Just following on from that with regards to payments as such, we have a very flexible, quite a large scope for where we can do automated valuations. So what we do is we assess it based on loan to value and loan size. So for example, any client borrowing on a remortgage on an AVM, we can do up to borrowing 250,000 up to 80% as typically, or offer a second charge, we can go up to 65% loan to value, borrowing 100,000. Clients that then qualify for an AVM as long as the minimum property value is 100,000 and the maximum value doesn't exceed $1 million. But we have had scenarios where it has gone over $1 million. And the confidence score has come back on an AVM for us to be comfortable to allow it to proceed on an AVM basis. So again, if you're not quite sure how it's going to work or what it qualifies, pick up the phone to either UTB, me, or SFS, who are our packaging partners for you. We have quite large loan sizes available. So for first charge purchase and remortgages, we're currently at £500,000 of borrowing. For second charges, we can actually go up to 400,000. This obviously falls into nicely, obviously, the loan purposes and what we can do for our clients. So again, debt consolidation, home improvements is probably the biggest area that we do our lending on. And the third biggest probably would be HMRC tax bills. Now we see more and more of them in certain times of the year, as you can imagine, and we see more so for sole traders who require to pay their HMRC debt, and we work quite well with HMRC, with the officers down there, in regards to ensuring that the payments are swift and efficient for the customer. Multiple reasons again. So we did one a couple of weeks ago, much to the horror of my underwriter, where they had to do 32 disbursements. Those disbursements obviously were quite significantly high. Client had a lot of debt, but obviously there was a lot of other things that were happening with it. It was a multiple reasons. So some of it was to do for an onward buy-to-let deposit. One was to do complete home improvements that had been done and racked up the credit cards. And I believe some of the other money was utilised by the children for their onward first-time purchase of a home. So again, multiple reasons why people can do a second charge or remortgage with us. We do support clients wanting to do onward purchases of buy-to-lets, holidays abroad, or their own second home. So again, there's a lot of flexibility there in regards to the loan purposes. I have mentioned, obviously, we have loads of products available. They are available either via myself or what Tony sent out to you in your packs. So please have a look at them, and any questions that you have regarding the products, please don't hesitate to give us a call. Obviously, Tony's and his team are on hand to go through any specific case inquiries for you. Obviously, I'm the BDM for the south of the country. the banks decided that the south for them means anything from the Midlands and Manchester, Liverpool, all the way down to Devon, Cornwall, and the southeast. So I have quite a large region, but I'm always on the end of the phone to support and ask any questions that you have. So thank you very much, and I'm happy to take questions now for everybody.
Okay, thank you, Kerry. Peter Wallace is typing something now, so I'll lose my voice already. So we'll wait for that to pop up. I do have a couple of, actually one question, pre-prepared one. How do you view payment holidays in the current climate?
So yes, so I touched on it briefly with regards to, sorry, I think I've lost you there for a second. I don't know what's happened. Yes, so payment holidays is the flexibility around it. So as I've mentioned, if the clients prove that they're out of their payment holiday and it was a pre-arranged payment, we will technically disregard what is showing on the credit file. So we will accept clients secured, unsecured payment holidays are acceptable to us.
Excellent. We've got a couple of people typing now, but just waiting for those to come up. I didn't. We did have 4 questions, but you'd already answered 3 of them in the presentation.
Always ahead of myself there, aren't I?
I won't ask those again because people will wonder what's going on. So Atul has asked, would you consider retained profits?
Not for limited company directors as income, I'm afraid. It's only for sole traders that we would look at retained profits.
It's quite rare, I think, that lenders will look at that. I think some first charge lenders that will look at, but certainly in the second charge market. Can't currently think of anybody. We might have a lender fairly soon that will on the second charge side, but I can't think of anybody at the moment. So no. Peter's still typing, so it could either be the longest question in the history of mankind or he started asking something else. So we'll give Peter another couple of seconds. Just with regards to UTB, I mean, Kerry's already mentioned that they were lending throughout. I mean, UTB for the second charge market, the brokers in the second charge market really were invaluable over lockdown. And there's a few that really could have struggled because, unfortunately, second charges, because there's only 20 lenders in the marketplace, only half of those to decide just to reduce their terms or just pretty much close down completely, as we saw with 3 or 4 of them. And it can have a massive effect on someone's business. So, yeah, UTB for us have been great during lockdown. I really have been great.
It's been a pleasure actually, Tony, to get some feedback from obviously yourselves, but obviously other people in the marketplace with regards to, it's given us more things to work on going forward in regards to you know, anything else that happens like this. Now we've certainly learned from it. I think the reassuring message that we'd like to put out there is that our funding line's our own. You know, we offer a life cycle of lending which has been going on since 1955, and it will continue to go on as well, because you know we're in a fortunate position where our funding line comes from our own revenue.
And the people behind it as well. So I'm still waiting for Peter's question to come up. The people behind it as well. We've got a sales director who's been in the industry for quite some time. But the managing director, Robert Owen, I've known Robert since 1986 or 1987, can't remember the exact date. And he's been through with a number of lenders over the years, some lenders, startup lenders, that proved to be very, very successful. He was the man who was behind Southern Pacific Personal Loans, Kensington Personal Loans, white label loans all the way back in 2007, which I remember very well because we were on the pilot when all the other lenders had pulled out. So Robert really does have a real background in second charges. He's probably the most knowledgeable and experienced person within any lender that I know of, by far. So Peter's still not asked his question. So Kerry, what we'll do, I haven't got any more questions. Thank you very much indeed. Great presentation as always. And shame about the Coy's comments we're getting.
I'll be wearing my football shirt for charity tomorrow, so.
Okay, yeah, mine doesn't fit me anymore, unfortunately. So yeah, I have to lose a bit of weight to get mine back on. But anyway, Kerry, thank you very much indeed. Much appreciated.
Thank you very much.
So. Okay, welcome back, everybody. After that short break, next presentation is about to start. So I will begin. Okay, our third speaker is Jonathan Prince from Allica Bank, who's somebody I've not met before, by the way, because we came on board with Allica over the summer, and obviously we've not been able to meet Jonathan because we've been on lockdown. But so it's the first time I've seen him. I had this horrible thought last night that we had the wrong photograph from, because I always expect them to be a bit older, to be honest. I have no idea why. Can you hear us, by the way?
Yes.
You
can you hear me?
Right, so just on to, first of all, Jonathan, you haven't seen this because I knocked this up the other day. We've developed a product guide for Allica, which you've all received by post, which is a nice A3 glossy bit of paper with all basically their current terms and exactly what they'll do. So please refer to that either on the email or the posted version that we sent to you. Okay, a little bit on Jonathan first of all. He's been working in commercial finance for the last 8 years, all of which has been spent with small challenger banks. He has largely worked in credit functions, giving him a strong understanding of business risk, and moved into relationship management at the start of this year. I'm intrigued by this one, by the way. Interesting fact, Jonathan has moved house 26 times in 31 years. And my initial thought was maybe he's on the run, but I doubt that's actually the case at all. So Jonathan, please explain.
It's unusual for being part of the settled community, but my parents were house renovators when I was younger. So there was a lot of move in, do it up, move on.
Okay. So, same schools, or did you say the same sort of schools, or was it the movement?
Mostly.
Yeah. I can imagine if you was like moving school like 20 odd times over your school years, it must have been absolutely horrendous. Yeah. Okay, so what we'll do now, just the next slide, Jonathan, it's over to you.
Fantastic. Thanks, Tony. So thank you for inviting us along, and big thanks to the specialist team for their support so far. Purpose of this really, Allica is a relatively unknown name in the market, so I just wanted to take the opportunity to introduce you to Allica Bank and who we are. So, as I say, I'll go over a little bit about us and the bank, what we're working on, our products and processes, and any questions you might have at the end or as we go through. So, cracking straight on. So, Allica are one of the newest business banks in the UK. We obtained our banking licence in September last year and opened our doors in October. So, we've only been trading for just over a year. And we launched with the purpose of empowering SMEs to succeed. So the way we're looking to do that is a combination of local relationships, so myself and the rest of my team dotted across the country, and also using cutting edge technology to try and deliver that easily and simply into the broker market. Our ownership is largely Warwick Capital Partners, who are a private equity fund, and we also have some funding from BAE Systems Pension Fund, and that funding has basically enabled us to continue lending throughout lockdown and raising deposits. And being a bank, we have that additional advantage of being able to get deposit funding, so we haven't had any sort of capital issues over the last few months, which has been nice. So, as I say, SMEs are our core focus, and we're looking to build a full service SME bank in time. So as we stand today, we take deposits from both the business and retail markets, and we use those to fund commercial owner-occupier and commercial investment loans. We are launching asset finance before the end of this year, and during the course of next year, we'll be launching our business current account. And once we've got that in place, we can then start to provide all of the facilities you would expect to see alongside that. So overdrafts, unsecured lending, card facilities, so on and so forth. So onto our products, and this is just to give you a little bit of an overview, although all this detail is in the product guide that Tony referenced a moment ago. So we lend to SMEs based in England and Wales. And those borrowers can be limited companies, LLPs, partnerships, or sole traders. We can also handle SPVs and NewCos not yet incorporated. Loan sizes are from 150,000 to £2 million, and they're secured by first charge against a property, again in England and Wales. LTVs are typically up to 70%, but I'll come on to those in a little bit. And we do lend for committed terms of up to 20 years. So that means it's not a 20-year repayment profile, but only a 3 or 5 year commitment. That is a fully amortizing term loan. And for our owner occupiers, we offer that on either a capital and interest basis, or we do give them the option of having a 2-year interest only period at the start of that loan. Our margin range is between 4.5% and 5.85% for our owner occupiers. And in essence, the way we calculate that is partly on the loan to value of the proposition, but also partly on the credit score of that borrower. So what that means is the better quality customers are benefiting from the better pricing that we offer. Debt service cover is 130% using adjusted EBITDA. And if there's a capital repayment holiday taken, that must be over the 18 years remaining on the amortising term. Security is also a place where we set ourselves apart from the market. So we don't, by standard, take personal guarantees or debentures or anything like that. Our security is a first charge over the property. And the only time we will look to take any additional security is where we've got a real need for that. So, for example, if repayment cover isn't quite where we'd like it, we may take a personal guarantee for a couple of years repayments, but we're by no means taking 100% personal guarantees as a matter of course. Now, our investment product is very similar to our owner-occupier product. The key differences here really are we offer a pure interest-only term for investors. So that is up to 5 years at 5% below the normal maximum LTV and up to 10 years at 10% below. And just to reflect our commitment to those trading SMEs, we do also price our investment loans ever so slightly higher. So they range from 5 to 6.3% above Bank of England base rate. Debt service cover, again, we've kept really simple. So it's a straightforward 135% cover using gross rent. There's no stressed rates, there's no gross rental deductions or anything like that. And we have exactly the same approach to security as well. So just a little bit more on our debt service cover calculations. In essence, our owner-occupier loans, like I say, are calculated on adjusted EBITDA, and that is essentially operating profit less any dividends or drawings or ongoing capital expenditure, and adding back in any rent or one-off costs. And again, our investment 135% on gross rent over a 20-year term. We do look for that affordability on a 20-year term, even if we are doing a shorter interest-only profile. And that's just to try and eliminate any refinance risk that that transaction might present. So onto our property types. As I say, we're typically up to 70 or 75% of vacant possession value. And these are the property types that we'll lend against. So the 75% there is reflective of professional practices, which we class as doctors, dentists, accountants, solicitors, all those types of firms, and holiday lets. 70% is our typical margin for anything with an industrial use, so warehouses, industrial space, and also for the better quality office and retail propositions. Given everything that's been going on the last few months, our appetite on retail and offices has been slightly tempered. And in essence, we just look for really strong propositions to get that 70%. So well-experienced borrowers, nice quality assets, good repayment cover, but we are more towards the 60 or 65% on those assets at the moment. And food outlets, cafes, restaurants, anything like that, and student accommodation, we're at 60%. And that is purpose-built student accommodation, so not so much a HMO, but more of a purpose-built halls of residence. And even in the current market, with properties that include that inherent goodwill in their market value, so day nurseries, pubs, hotels, restaurants, convenience stores, we do lend against that goodwill value. So as you'll see there, they're all at 65% of that trading value, and then tempered by either 70 or 80% of the bricks and mortar, depending on what type of property it is. So I think it's just as useful to touch on what we don't do as what we do, because actually what you find is most of the inquiries you get through are more the things that aren't quite so straightforward on your product guide. So we have the usual exclusions here around arms and weapons, adult entertainment, gambling. We don't lend in those sectors. And also as a bank, we've currently got no appetite for any CQC regulated business. We don't lend on religious buildings or nightclubs. And we don't lend on any residential leisure facilities, so park homes, caravan sites, campsites, all those sorts of things. But if there's anything that's not covered by this, by all means, divert some queries over to the specialist team and we'll be happy to help them out. So the application process is one that we try and keep really simple. So all of the team at Specialist have got access to our dedicated introducer portal, and that allows them to submit decision in principle or full applications straight through to us. One of the advantages of us is all of those applications go straight into our credit team. So particularly for a lot of you guys who are going to be too removed from the usual process, you're not going into Specialist, then into me, then into an underwriter, and then back through that route with queries. Those applications go straight to the underwriting team, and if they've got any queries, they will raise them direct with the Specialist team as well. Once they're approved, and the typical turnarounds on that is 1 to 2 days for a decision in principle and 5 days for a full application, an offer will be issued. At that point, we ask for our fees to be paid, and we will instruct the valuers and solicitors and get on towards completion. So information that's needed for the decision in principle is kept really basic. It's in essence used for an indication of whether a proposition sits within our appetite, but also the headline terms that we would be able to lend on. So we ask for the business name and company number if it's a company or LLP, and details of just one person in that business who's applying on behalf of the company. We ask for the headline numbers in terms of affordability, so turnover and EBITDA for trading propositions, or if it's an investment deal, we ask for lease deal details, and just some basic information on the property as well. Onto the full application process. As you'd expect, we do need a little bit more detail here. In essence, we're asking for names, address, history, and dates of birth for all the individuals, nominated account details, and some supporting information. Now, we try and keep that to a sensible minimum. You know, we're not asking for 20 attachments to be sent over to us just for the sake of it. We are very much focused on information that's going to impact that proposition. And our underwriters will genuinely only request additional information if it's really needed. So fees and commission, we ask for a 0.25% commitment fee to be paid on acceptance of the offer. And the rest of that arrangement fees, the arrangement fee is 1.5%, but the commitment fee forms part of that. The balance of the arrangement fee can be added to the loan outside of our maximum LTVs. And valuation and legal fees, again, we use one partner for both of these. We use 3PS for our valuations and Leicester Aldridge for our legals. Now, what that means is we can commit to a fee scale for most transactions. So you've got that upfront certainty of what the costs to your borrower are going to be. So what makes Allica different? We do have, as I say, a genuine focus on supporting trading SMEs. It's why we launched. We felt that there was a real gap in the market for businesses that genuinely focus on trading SMEs rather than investors. And particularly over the last few months, there's been a real lack of funding there for a lot of really quite strong businesses. We also offer direct access to our underwriters, which again, we feel not only speeds the process up, but just shows that common sense approach to getting deals done. And our flexibility around things like our approach to security and our ability to lend against those open market values for trading businesses. So, as it says here, for any documentation queries or any appetite queries, please feel free to go through the specialist team or use the links that are shown on screen now. Thank you very much. Any questions?
Jonathan, thank you very much. We've actually just had a question, quite a long question actually from Peter Steele, so I've not read this yet. So, hi Jonathan, I place a reasonable amount of commercial lending business. I presently have a good solid case to provide. However, am I right that I would have to transact through one of your approved panel brokers? This is not something I'm particularly comfortable with or usually used to doing. Thanks, Peter.
Yes, so we do have a dedicated introducer panel, and anyone does have to be a member of that panel to be able to submit business to us. In terms of anyone on this presentation, obviously specialists already have that panel membership in place, so you'd be more than welcome to go through any of the team there to submit business.
Okay, Peter, more than happy to speak to you separately. We've got hundreds, I would say hundreds, it literally is hundreds of people using us at the moment, placing business through us, and purely on a package basis if they wish. We don't have any customer contact, and believe me, we are very good at what we do, so is all I can say. Pete Dawes is just typing something, and so is Peter again. So just whilst they're doing that, I've got a couple of questions pre-prepared. Are you an online-only bank, Jonathan?
We aren't. No, we don't have traditional branches in the sense of your normal high street, but we do have, as I say, a team of relationship managers spread across the UK. That team is currently sat at 8, but growing very rapidly. And the plan is to have relationship managers no more than 50 miles away from anyone over the next 18 months.
Okay. Atul has asked the question, I gather you lend on goodwill as well. Is that with freehold security?
It is, yes. So we don't lend on any pure leasehold businesses. Everything does have to be property backed for us at the moment. But we just, for those types of businesses where you've got inherent goodwill in the property value, we will allocate some value to that in calculating our maximum loan.
Okay. Next question I've got is, how do you treat OpCo-PropCo scenarios?
So one of the things that makes us quite unique is this exact scenario. So where you have an operating company and a property company, a lot of lenders will insist on leases being put in place and them being treated as investment transactions. We will actually undertake a full look through to that trading business, and therefore be able to use the full profits available, and also they'll benefit from our lower rates for owner-occupiers.
Okay, Pete Dawes, I've known Pete for a very, very long time. Pete, I actually met on a roundtable event held by, I think it was Financial Reporter, about 3 years ago. And I sat at his table and we got chatting, and Pete's been doing business with us ever since. So hi, Pete. Thanks for attending again. Peter said, I can't recommend Tony more strongly than to say they always look after my clients and I wouldn't use them if they didn't. So Pete, thank you very much for that. I should get you presenting, Pete, with comments like that. That'd be great. And Peter still said, thanks for your comment, Pete. So I haven't got any more questions, Jonathan. If anyone's got anything else, Pete Dawes is typing something again. But Jonathan, I think we're done actually fairly early. So it's not quite 11:45 yet. So Pete Dawes said, my bank details are in the post. I've already got your bank details, Pete, because I paid you recently on a case, I believe. So, but thanks anyway, unless you change your bank details, of course. Jonathan, thank you very much indeed. Nothing else to ask. Thanks for the presentation. Much appreciated. Lovely to meet you at long last. Likewise. And my staff will no doubt be in touch with you probably this afternoon, I should imagine, or as soon as you finish this. So, okay, thank you. We will move on to the next speaker. Okay, so our final speaker, and we are ahead of time. I'm hoping that he's going to be appearing anytime soon, is this gentleman, which is Andy Virgo from Lendinvest. Strangely, Andy is the last speaker we've got this year, but he was also our very, very first speaker on our web shows back in the first one we did on the 2nd of July. So he started it and now he's finishing it, which is great news. Everybody, what you should have received, Andy, by the way, can you hear us? Just making sure you can hear us.
Loud and clear.
Fantastic. Okay, nice little backdrop there, possibly a wardrobe and a nice picture on the wall. I can see. Excellent. Okay, so everybody, you would have received Lendinvest's latest terms, their product guide and matrix, which includes their most recent change on the 10th of November, I believe it was, when new product they released. So please refer to that. Again, if you haven't had it in the post, then just check your email because I've sent it to you this morning. If you haven't got either, then let us know and we'll get something over to you. Okay, so first of all, just a little bit about Andy, who joined Lendinvest from Interbay Commercial in July 2017 to assist in the development of Lendinvest's entry into the buy-to-let sector. He was previously a senior BDM within the One Savings Bank Group, and he worked as a commercial mortgage broker with Christie Finance and established a property finance brokerage in 2006 after a stint with NatWest in their real estate team. Initially charged with product development alongside broker management, Andy took on the role of head of key accounts when Lendinvest joined forces with the industry's mortgage clubs and networks. After winning the NACFB's Best Buy-to-Let Lender Award in December 2019, it won't be the first time you hear that, by the way, during this presentation, Andy was subsequently promoted to the Director of Buy-to-Let, thus responsible for the development and subsequent success of Lendinvest's buy-to-let proposition. Just to add to that, before I go on to his interesting fact, is that it's seldom you see when a lender launches into the market with a completely new product that it's as seamless and as successful as this one has been, and much of that really is down to Andy, and that's not blowing smoke up his, you know what, it is the truth. It really has been brilliant for those brokers that were there right from the start. It's been fantastic. It really was. The fact that the way they work, it's most of it is it's electronic signatures on offers, electronic signatures on applications, etc., etc. One of the first to do it in the specialist market. Others have now copied purely by taking on the same software as Lendinvest have, but haven't done it as well. But they really have been a breath of fresh air in the marketplace. So on to Andy's interesting fact, because we're running way ahead of time now. Andy's interesting fact, which he will explain to you, is that some might be surprised to learn that Andy once broke his leg in a swimming pool that did have some water in it. He didn't fall in it drunk. So I'll let Andy take over the explanation of that. And the next slide you'll see will be Lendinvest. So Andy, over to you. What happened?
Thank you, Tony. Yeah, I was 6 years old, and I had bought, or I've been given, an I Spy book of diving, one of those old Ladybird books, and it said, sit on the side of the swimming pool, rest your feet on the bar, put your hands out in front of you, and just gently fall forwards into the water. So that's the beginner's guide to diving. What they didn't say is make sure your leg doesn't go behind the bar because you'll break it. My dad waded across the pool, saw me flailing underwater, grabbed me, saved my life. So yes, I now only dive from height. Yes, so on to buy-to-let, and before we've got a bit of time, so there's a bit of poetic license perhaps that I'd like to extend some thanks to Tony and the team at Specialist Finance. I'm the last speaker of last lender speaker of 2012, and I wanted to say thank you on behalf of all of the lenders that you've given exposure to this year, Tony. Tony doesn't, for all of you guys, Tony doesn't charge you to come to these events, and he doesn't charge us as lenders either. Tony promotes a best of breed panel of lenders, and as such, as per Peter's point he raised earlier, there aren't many, if any, better brokerages that are able to support clients for you as brokers who can't access lenders direct. So we transact business through Specialist Finance. It's been strange doing these presentations to looking at yourself all the time, but it's real world problems. Instead of fire alarms going off during meetings, we now have dogs barking and dustbin lorries pulling up outside. So yeah, it's been a bit of a strange year. So moving on, a little bit about Lendinvest as a business. I'm going to talk to you today about buy-to-let specifically, but it's important to understand our roots and where we've come from. We are a relatively new business in that we were only established in 2008. The directors saw an opportunity post the credit crunch, and they set up a small brokerage, just 3 people in a room with no windows, and they started trading, started to go down the peer-to-peer route, to be honest, but quickly worked out that that wasn't a viable way of getting lending out there. So yes, we do have people that invest in our business, and those are anything from individuals to some very, very significant names. So we started our journey with bridging, and then we bought on development as a new product line, sort of around 2015. That's grown. We assist people with development of multiple properties for residential use. Typically, we want to finance development projects that come in the sort of help to buy area of purchase activity. So I joined 2017, and it's almost probably literally 3 years almost to the day that we actually started getting our first applications in. It was wonderful to win that accolade last year, and I'll come on to that again after 2 years of trading. But here we are now as a buy-to-let lender who is looking for growth. You're going to hear a lot about us moving forward, and considering our youth within the market, I'm going to explain today quite where we sit, how we're positioned, and why you should be using us. But before we go forward, let's go backwards. So the year started off with a bang. We were flying. Who knew January, February, what we were going to enter into this year? I certainly didn't. Well, nobody did, apart from the Americans, who obviously knew about it in September, but Trump kept it quiet. But let's just keep it off the politics. Anyway, so our buy-to-let proposition was flying. We had 80% loan-to-value products. We had interest rates that were around at 2.89 for our 2-year fixed rates. And service was great. You know, we were receiving applications and getting the applications in, the underwrite done, the valuation completed, and the offer was going out in 14 days. So 65% of our cases were going from application to offer within 14 days. Then I went on holiday to Egypt at the end of February. So end of February going into March, started hearing around the pool bar some conversations about Spain and Italy and COVID, and wondered what it was all about. Paid very little attention to it. Needed to top up my tan. Suffice to say, got back to Gatwick, saw a load of masks in the baggage hall and passport control, where everybody was obviously herded together. But then lenders started kind of pulling products, and brokers were cancelling meetings, and valuers weren't able to go out and visit properties. So the kind of world stopped spinning for us all in this industry. We did eventually secure support for a desktop valuation for buy-to-let. It was something that we launched at the 11th hour. Just as we launched it, it was called Buy-to-Let Plus. The valuers announced that they were coming back, so we only had about a 3-week window. We didn't get any applications in, but hey, we're ready should the valuers not be able to go out again. And I don't think there are many lenders that are ready like we are should the worst happen again. So where are we now? Well, it's mid of November, Christmas tree's up already, thinking about presents, but I've not been out of my son's bedroom, my office, since the middle of March. Everybody's working from home. My whole business is working from home, but it's business as usual. We're still working hard to research the market. We're still keeping an eye on what's going on with the economy, listening to the feedback from the valuers. We've got all the funding that we should need. We managed to stay open through the lockdown because we'd actually securitized, believe it or not, on the Friday before we were locked down on the Monday. So we had an empty warehouse and a big bank balance. So we were able to carry on lending. We just queued up applications for valuers to visit once they came back. But even now, even today, we're still taking a very measured approach to the decisions we make around the products that we advertise to be available for landlords. For example, you know, the 80% product, it's not something that's widely being advertised, certainly isn't priced very competitively. It's probably just a token product, to be honest, a bit of a halo product to get you all looking at the rest of our rates. There's only 2 or 3 lenders actually offering that. So we're in lockdown 2. I'm not able to go down the pub. Tony's not able to go down the pub. And we are suffering again. Hopefully it's just a short period of inconvenience for us all, but it's very important that we keep you up to date with what's going on in terms of our service levels. It's business as usual. Up to date information can be found on our website in our help section, and it's very much a case of business as usual. To prove that, we're publishing our current processing times, and as such, there's one story that I have which has hit the press today. We've actually completed a buy-to-let deal in 4 days. We recently had an application in from a firm for an HMO, deal. We managed to get the deal through our paperless online process. All the documents are signed online, so you can literally go from application to signing your agreement as soon as the valuation is done within just a couple of days. And we proved that by using Burkitt's, our new legal partner that we've just brought on board, in readiness for what's going to happen with the stamp duty window closing. We're gearing up with further legal support. We managed to complete that application in 4 days. It's incredible what we can do when we're motivated, and as I've just put on LinkedIn, we even surprised ourselves. So where are we today? Well, business is booming. Every month's a record month. The number of applications that we're getting is incredible. There's some good quality business to be had. 74% of our business is limited company buy-to-lets. 65% of our business is purchase, which it's unknown. Normally we are heavily swayed towards remortgage, but now it's obviously very much purchase is king. So there's more cases coming in, more cases per brokerage. People are getting familiar with us. People are using us more because the processes and the systems that we have are very clean, and they work perfectly for this current climate that we're in, with lockdowns and inabilities to visit maybe solicitors or something to sign documents. So why are we so busy? Well, it's no great surprise. Everyone's been talking about the stamp duty holiday. We have had an awful lot of, not awful, it's the wrong word, we've had an incredible amount of landlords who are using this as an opportunity, this lack of stamp duty, using it as an opportunity to incorporate some of their personally held properties. So moving those properties from their own name into a limited company, there's a saving on stamp duty, and you can hold over the capital gains tax charge until you sell the properties outside of your portfolio. So we're doing an awful lot of incorporations, and there's a lot of people coming back to us time and time again to purchase more and more property because they're seeing this as an opportunity to get some good quality stock. I don't know really if sorry, let's explain this a different way. So recently there was a kind of report that property prices are up. We're all seeing these property prices are up across the country. Well, there's a report that came out, I think yesterday, that said property prices have started to go down already because people who are looking to sell are looking to make sure that they can move before the stamp duty holiday finishes. So where people have put the price of their property up, thinking, well, stamp duty's been cut, let's put the property up, price up and let's sell it because there's a lot of activity. They're now realizing that those property values need to come down in order to generate some proper interest so they can complete those mortgages and moves before the stamp duty holiday finishes in March. So where are we in terms of our products? Well, going through our products, this is a very, very fast moving industry. 80%'s back, as I said. We've got interest rates on our 2-year product starting at 2.99, our 65% loan to values. As we're responding to the fact that there are a lot of people out there who have taken payment holidays or payment deferrals, as they should be referred to, government bounce back loans, etc. We're okay with people who have done that. We're okay with people who are furloughed, receiving lower income than normal. We use open banking, which I'll come on to again in a minute. We use open banking to ascertain the borrower's up-to-date financial position. One, it enables you to deal with us without having to submit oodles and reams of bank statements and mortgage statements, and it allows us to underwrite the deal much more quickly. On that note, we are offering £200 cashback for any application. £200 goes to the applicant for them to use against their spend against their legal costs if they allow us to use open banking. Like I said, it speeds the process up for us. It allows us to make the right decision at the right time, and is certainly helping us and landlords and brokers alike. There are some 5-year fixed rate products that attract £500 cashback. Those are available and visible in our product guides. So we're looking at the market, we're looking at what we need to do to best serve our clients, being both you and the landlords that you deal with. And we've recognized that we need to make some changes and some improvements. That's my role. My role within the business is to drive the buy-to-let proposition, So anything to do with our buy-to-let proposition, I'm looking all the time to try and tweak it to make sure that it is fit for purpose. So we've increased our maximum loan sizes up to £1 million, which used to be 750. We've increased our maximum loans at lower value to 1.5 million. We accept new builds now. New builds are attracted a bit of a premium, really, and the value of new builds can go down quite quickly. So we were a bit sceptical for a while around new builds. So new builds, we're back at 75% loan to value. A new build being a property, a flat or a house that's been built within the last 12 months. First time landlords, obviously people trying to jump on the bandwagon at the moment. We need to be very careful about people with no experience of letting property getting into the industry. Will they make a success of it at a time when securing your next tenant is actually quite a hard thing to do? But we're happy to support landlords who are new to the market, but at a loan to value of 70%, which is quite a sensible level. Studio flats, people are moving out of London, might be looking to rent flats in London, small studio flats, they're back. We've also made some improvements to our HMO range. Now, the HMO range is split into two, small HMOs and large HMOs. So up to 6 room HMOs, we charge a fee of 1.5%, and we have quite compelling interest rates. Most purchases seem to be limited companies. If you look at the sourcing systems, we will be figuring quite highly on sourcing systems for these HMO products. And we're also quite happy to lend to student lets. We did withdraw from the student let market, as some lenders did. We waited until students went back to university. We appreciate that students want to enjoy that student life and are keen to get out of home and start move away and experience new things. So we're happy to support those people moving forward. Finally, multi-unit freehold blocks. We are currently reviewing the price position on those products, but we've increased increased our loan to value up to 75%. So multi-unit freehold block is a property with up to 10 units on a single freehold. The 80% loan to value product was an interesting one. It's a bit of a halo product. It's a maximum, being perfectly honest, as I always am. It's a product that's out there to get people interested. 80% loan to value maximum. So you can't be adding your fee over and above the loan. Maximum loan size, £500,000. The interest rate's quite high. We've got a minimum income on this of 40,000. We haven't burst the banks with this product, and we're not really worried about that. It's a halo product, as I said, to get you to hopefully get some interest in the other products that we have. 75% is much cheaper. We source extremely highly for our 75% 5-year products, and as such, 75% with a fee added, it's pretty close to 70 to 80% with a fee minused off. So this product needs to be tweaked next year, but we've been purposely careful because we want to see what's happening with property prices. Now, what I'm about to say is, if you tell anybody, what's the phrase? I'm going to tell you a secret if you can't, but you can't tell anybody. So Tony doesn't know this because this has only been agreed this week, and these slides were submitted at the end of last week to give Tony and his team time to get prepared for today. So our pay rate product that is currently stressed at 4%. So anybody looking to buy a property, we stress 125 at 4%, whereas on standard rates we stress 125 at 5%. We're not regulated by the PRA, so we are able to use a 5% stress test for our standard products. So we've had a pay rate product where we stress at 4%. We've just released a corporate pay rate product at 3.69. Now this has been out for 2 weeks, so this figured in the last update, the beginning of on the 2nd of November. Little does Tony know, but we have just reduced this. On Monday, this product becomes 3.64. So 3.64 stressed at 125 at 3.64 for limited companies only. We've also reduced the fee from 2% to 1.5%. There's no cashback available on this product or our pay rate products, but in terms of the sourcing systems, it's great for leverage. It's great for rate. It's It's a product that you'll find very, very accessible. It was the missing piece in our jigsaw, effectively. So just to confirm and reiterate the types of properties Lendinvest will lend on: standard properties, houses, flats, flats above commercial are okay. We're even okay with properties and flats close to pubs, churches, social clubs, restaurants. Just can't be next door to them. HMOs up to 6 rooms, large HMOs up to 10 rooms. I'm doing a body of work at the moment, a project to actually reinvent our HMO offering. It's already very good, but we want to start introducing tracker mortgages as well when we transition away from LIBOR across to Bank of England base rate. Probably by the end of the year, that's something we're going to introduce. So watch this space on our HMO products. They're going to get even better and even more compelling than they are at the moment. Multi-unit freehold blocks is quite a sound investment at the moment. You lose, a bit like HMOs, if you lose one tenant from a multi-unit freehold block, it shouldn't really affect your ability to service a loan. Interest rates, we're not going to go through these interest rates at all, except to say they're out of date. So as these were okay as of last Friday's submission of this presentation. On Monday of this week, hot off the press, the 70% 2-year fix, the 75% 2-year fix are being reduced. I think it's about 3.19 and 3.29 respectively. So quite a cheap 75% 2-year fix, 3.29%. We've got a new 5-year fixed rate product coming out with about 3.54. So that's going to be coming out. And as I said before, we've got our pay rate products that we're reducing as well. Let's ignore that slide because it's now out of date. So let's go back to service. Now, I do an awful lot of work with sourcing systems. I manage the sourcing system relationship within Lendinvest with Trigold, 27 Tech, and Mortgage Brain. It's a dark art. It's an absolute pain to deal with these sourcing systems because they're all different. They source differently. They have different parameters, even though they're supposed to be effectively offering the same solutions. We can achieve one ranking with Mortgage Brain and achieve a different ranking with 27 Tech. So the other variable is how you will search. You know, Tony talked about brokers searching, you know, the FCA not being keen for people to search just on rate alone. What does a customer do when they phone up? First of all, what's the cheapest rate we can get? It's not about the cheapest rate. You all know that. It's about the cost over the term. So when you're searching for us, search for the total cost over the term. Don't include the ERCs if the customer's not expecting to have to remortgage during the term of the loan. And you'll find that you'll be able to justify using us. I'm not saying justify using us because we're more expensive than everybody else. I'll come on to our market positioning in a minute. But actually, we are very, very well priced. And if you look at the overall cost of borrowing across the term of the mortgage, we are there or thereabouts. But it's not just about the term, it's about the rate, about the fee, it's about the service that you can provide. I've just told you about a deal that we've done in 4 days. Now, we use technology to the nth degree. We're a fintech business. We're looking to shake up the finance industry and do everything we can to make sure that we're using technology for the good of the deal, for the good of the relationship with the broker, and for the ease of the client. So our online application in our portal is completely that. It's online. You upload any information you want to send to us. But on day one, all we need for an application is proof of deposit, if it's applicable, and the customer's background portfolio spreadsheet. We're not regulated by the PRA. We do not need cash flow forecasts, asset and liability statements, business plans. We don't need any of that. The stuff that clients don't want to send and you guys don't get paid to put together for people. So the basic information that we need, just the proof of deposit and the background portfolio on the whatever spreadsheet it's in. It doesn't matter whether it's another lender's spreadsheet or your own spreadsheet. As long as it's got the basic information on, that's enough for us to get the deal underway. So very much paperless process, e-signatures. I mean, how many lenders at the moment are saying to their customers, to their landlords that they're dealing with, so you're working from home, are you, Mr. Customer? Or can you just print these documents off from your printer to sign them? people might not have a printer. So that's going to delay the deal. Well, I'll put them in the post. The post is slow enough as it is. So maybe we should get Amazon delivering mortgage documents. But no, we use online paperwork, online signatures. So everything's done in an e-signature. So wherever you are, you can get these documents, loan agreements signed via e-signature. We don't need proof of, I know you have to collect proof of address, proof of identity. I wish everybody was as joined up in terms of technology. We don't need anything like that. We will send the customer a link to something called on FIDO, which we ask them to take a photo of the passport and a photo of themselves, just a selfie. That's enough for us to get our ID sorted. Valuation payments are made online. Open banking we've talked about. We're using what they call APIs. I don't know what API stands for, but it's about integrating software that's available into our underwrite, so we can quickly understand if there's any, our fraud checks done immediately and quickly. We don't have to use different systems. We have built a system ourselves that brings in all of the technology from Equifax to CIRA that allows us to get these cases underwritten accurately and quickly. So just touching on that cashback again, there are 5-year fixed rate products that attract £500 cashback towards legals. And in our desire to get the UK using open banking, it's a bit of a touchy subject, that people don't understand it. It's something that the FCA and the government should do more to explain. We're doing the best we can. It's not a Trojan horse. It's not a way of finding out people's deeply held bank statement history. It's just looking at a snapshot of their financial position and incentivizing people to use that by providing some cash back towards legals aids you and us and them in the process. So I talked about more market positioning. These are our peers. So when we talk to you guys and you come to these presentations, we never assume that you know everything or half about what it is we do. So this is a slide very much to be open and honest, to say this is the market that we are within. If you are using any of these lenders and you're not using Lendinvest currently, please stop, take a time out to have a look at our website. There's a very interactive website with lots of videos and all sorts of stuff around process and some of the technology we have. There's lots of information around guides, and there's a market leading calculator. I don't think there's a lender out there with a better calculator than we have for all of our products. So if you're dealing with these lenders, just pause, just stop, just give us the opportunity to understand what we do, and Tony can help you with any case inquiries that you may have. Are they good for us? So when we look at pricing ourselves in the sourcing systems, we're very much looking to not beat Paragon or Precise. We very much want to position ourselves ahead of the Aldermores, the Zephyrs, the Peppers, the Vidas, the Foundations, the Keystones, the Landbase. That's the ideal position for us. We can't do it all the time, but that's the ranking that we want to have within the market with our products. So just to recap, with us, leverage is easily achievable due to the fact that we stress at 5% and even have these new pay rate products that we've been missing for a while. The cashback's a great incentive. We are very much on the front foot when it comes to the right positioning with rates and fees down at 1.5%. We're very much aiming to keep life simple and be your lender of choice. So this is Tony's slide. There's all sorts of information available on the Specialist Hub. Cannot recommend Tony and his team's services more. This is the specialist industry, specialist part of the market. It is a technical market, and at times some of these cases do get very complicated. And the years and years and years of experience that Tony has in the industry, it means that he can actually help with many applications that are often seen as troublesome. So no apologies for this slide. I'm going to leave this slide here. It's a reminder of the fact that we won our Best Buy-to-Let Lender of the Year award last year, which is on our 2nd anniversary. It's voting season. December are the awards. We really want to win it again on merit, of course. We're not buying votes like you do in some award presentations. But if you recognise us as a great lender for buy-to-let lender of the year, short-term lender of the year, and for the first time BDM team of the year. So whilst we deal with any questions, it would be great if you could just remember to vote for us.
Okay, Andy, thank you very much indeed. We've got a couple of questions. Peter Steele has asked, and Peter, by the way, I've just had a look because we spoke earlier on. I had a look just for your telephone number and saw that where you're based is very, very close to where I grew up. So I'll give you further details on that when I do speak to you. But so Peter's asked, anyone expecting the stamp duty holiday could be extended by the government when the current position ends in March? No. Andy, what's your thoughts?
So look, we're desperate for it to be extended. I mean, this is a really, really great question, Pete. So let's look at it. It was introduced, the stamp duty freeze was introduced at a time when the valuers were back out and everyone was back out in the streets and pubs. And subsequently, we've got into lockdown 2. There's been a huge amount of activity during this period. As I said, we're at 65% purchase, when normally we'd be at 25%. Now, the government have come out and said, no, it's not going to be extended. I think there are plenty of people lobbying in the background that because of lockdown 2, and potentially, if you read the Daily Mail, you're going to, for having one day of 25th of December with your family, we're going to have to suffer another lockdown post-Christmas. So I'd say watch this space. The right thing would be to extend it. As far as we're concerned, we have already bought on a new solicitor, Burkitt's, and we are now searching for another solicitor to go to 4 legal partners. That's alongside JMW and Lightfoot's as well, who deal with our buy-to-let completions. It's all about trying to guarantee that we can complete mortgages by the 31st of March. Solicitors are bottlenecked already. Land registry is suffering. They can't keep up to pace with things. So from our point of view, we want to be accepting applications for purchases right the way into January and maybe even beginning of February. We'll be making sure that everybody knows on LinkedIn and all the other ways we communicate exactly where we are in terms of if you want to get a deal completed by the 31st of March, then the deadline for submission is going to be X or Y. We're trying to work that out now.
Okay, I know that the trade bodies are lobbying heavily as well on getting some form of extension. So I suppose it's just one of these things. Watch this space. Who knows? This year's been, if nothing else, it's just been a year of surprises as to some of the things that have been brought out. But yeah, just watch this space, I suppose. If we hear anything, then we'll let you know. Certainly let everybody know because we do like a bit of good news. Okay, that's number 3 questions. So I'll just read through these. So Atul, hi Andy, good seeing you again. Are you likely to introduce bridge refurb to let with one fee, as I know you have an excellent bridging team as well, and your mortgage processing team is excellent. I agree. When we look at total to pay Lendinvest, in majority of cases you come out on top. That is actually very, very true. One of the things we've done, I'm going to be talking about our commercial quote system a little bit later on. And one of the things we've done over lockdown is to also now include the cost over 1 year, 2 years, 3 years, 4 years, or 5 years. And we can then, very much like the sourcing systems, this is our own sourcing software, we can then see who comes out, because quite often that's the best indicator. Because you want to obviously just off, it's not all about the lowest payment, it's about a number of other things. And Lendinvest we're now finding are coming out in the majority of cases in the top 1, 2, 3, almost every single time. So Peter Steele has said, sorry, that's just a personal note. Actually, he was at Kaplan's First Financial in Stanmore. Okay, and he sends his regards. You can actually see it yourself, Andy. David Phillips has asked, will you allow search indemnity on purchases of leasehold properties in Hackney following the council's cyber attack?
Wow, that's a technical question. I'll give myself
on that one.
Yeah, I'll give myself a little bit of breathing room on that one for a second, David. Just to come back to Atol's question. So in terms of the question around a bridge to refurb, or a refurb to term or bridge to let product. So Lendinvest currently have a bridge to let process. So we are, how can I put this politely? We are hamstrung, being honest, by the fact that we have two systems, two databases, operating systems within our business. The buy-to-let is current, it's future-proof, it's all singing, all dancing, it's fantastic. Whereas the bridging process is a little bit Heath Robinson. It's held together by string and is a bit manual. It's more like a CRM database. What we're currently, because we're a fintech, 40% of our business is actually employees are techies. It's a huge part of our business, and we currently have a serious roadmap of development in technology that's going to very shortly result in a bridging process that will completely match our buy-to-let process. So it'll be online applications, e-signatures. We're already offering desktop valuations on bridging. So the ability to transition from a bridge to a term loan will be there in the future. Currently, it's two separate applications, two separate products, but we will look to tie that together with one fee. It's a product that I developed at Interbay, a refurb to term product, and we used to charge a single fee to cover both aspects. We used to give the offer for the bridge and the exit for the term at the same time. I know Precise do it as well, but their application process is extremely long, and I think actually it's paused at the moment. So Atol, AJ, I know you well. Thank you for the kind comments, and watch this space. It's definitely coming. Have I given myself enough time to think about David's question?
David, come back to you and go back to him in a few days.
So we're okay with search indemnity, but I don't have any details on the cyber attack. So via Tony, we will come back to you, David, for sure.
Okay, David just typing something back. I might just wait for that to come up, or because we have no more questions, so we are done. So no, Hackney can't do property searches since September. Okay.
Best buy property outside of Hackney.
Yeah, and they'll probably be fined by the ICO as well for having a cyber attack, no doubt. But we'll come on to the ICO later as well. Andy, thank you very much indeed. Thank you for being our first and also our last this year. It's been a pleasure as always. And we will see you. Well, I'll probably talk to you later, but we'll be seeing you again when we return with the Specialist Mortgage Web Show sometime in the new year, which I'll be coming on to. So, Andy, thank you.
Thank you, Tony, and thank you for your team for your support.
Thank you.